Hi, this is Kelly Wright at the Money Show in Dallas, and with me today is Mr. Keith Fitz-Gerald of Money Map. And so, this isn't your first rodeo. You've been around for a while.
Well, 36 years is a long time. You know, there's an 8-second buzzer with a rodeo, but 36 years kind of goes beyond that.
True beans, true beans. Okay, so you've seen it all and then some.
Well, you know, I'm not as smart as some people, and I'm not as dumb as the others. I mean, you know, perspective is everything. And on a day like today, in a market like we exist in today, I'd like to think that counts for just a little bit.
You know, let's hope. Let's hope.
Exactly.
Otherwise, we're all in trouble. So it appears that some market participants are starting to figure out that interest rates can actually go up.
Oh, remarkable concept. You know, this is astounding, because one of the things that's interesting about this, people think that it's the Fed that sets rates. And I've maintained for a long time, it is not the Fed that sets rates. It's the global bond market that sets rates as a function of risk, not return. And what this means is risk is changing.
This is apostasy that we're hearing here.
I know, heresy. I'm going to be banned from every cocktail party on Wall Street next.
So what you're saying is that it's a supply and demand market and a risk and reward market. Is this true? Is this what I'm hearing?
Well, very much so. This is eggs in the grocery store, right? Okay. So if you have one egg and 1,000 buyers, guess what happens to the price of the egg? It skyrockets. If you've got 1,000 eggs and one buyer, it falls. Okay. So when the markets are leveraged, when rates are running, what it means is the amount of money chasing the eggs changes. So the price of the eggs falls.
Okay, so leverage. Let's help them out. Where's the market leveraged, and how is that playing out?
Now, for the individual investor, you hear a lot about margin, but that's really not what should concern you. What should concern you is how institutional traders are levered. Okay. Because institutional traders will take $1 and they'll turn it into $7, $8, $9, $10, which means that if the market moves as little as 0.5% or 1%, they've got to panic, because all of a sudden, out of the 9 fake dollars they hold, there's only one real one. They've got to unload things as fast as they can to get back to the point where they don't get a margin call, just like you would on your house if you defaulted on a car payment, something like that. That's the game that's being played and why it's so volatile.
So that's a double-edged sword, is what you're telling me.
Well, for an institutional trader, yes. Okay. But for an individual trader, this is the mother of all opportunity.
Okay.
And here's why.
Okay.
So one of the things I talk about in the Money Map report constantly is the need to focus on unstoppable trends, because they're backed by money that's going to get spent no matter what Wall Street does, no matter how the Fed moves rates, and no matter what Washington does. Okay. Smart or not.
Okay.
And so a thing like this, a big down day, yes, it's scary, yes, it's terrible, but if you understand why the institutions are unloading and you know what happens next, as soon as everything calms down, they go right back at it, they lever back up, and they go right for the world's most valuable stocks, because they're going to get the most juice for their money.
Most bang for the buck. So what you're telling me then is that with institutions, they're using borrowed money.
Oh, yeah.
A lot of borrowed money.
They're levered up to their eyeballs. And this is one of the few advantages an individual investor has in today's world. Everybody thinks debt is bad. Well, if you're an institution, it's terrible. But if you're an individual investor and you know how and why they think, you can use every time they panic to your advantage.
We're going to spend some more time on this. We've got a lot to do on this, folks. I'm Kelly Wright at the Money Show in Dallas with Mr. Keith Fitz-Gerald.
See you next time.